Working Man Investor. Today's video, interest paid on the U.S. debt soars. I have an article from the Mises Institution I'm going to go over. It goes over the CBO, the Congressional Budget Office's review of the Big Beautiful Bill, and it gives some estimates of how they came to the $2.4 trillion it's going to add to the deficit. The Big Beautiful Bill, when they say $2.4 trillion to it, it is essentially the best case scenario for the deficit. The CBO's analysis tend to assume away the existence of things like recessions. When we get a recession, people often think that the government's going to print money and do some helicopter money, give people money to spend to try to stimulate the economy. Not only does that add to the deficit if they do that, but what people seem to fail to realize is that when you have a recession, there's a lot less spending, a lot less people working. Therefore, you have a lot less tax collection. So it's not only the economy shrinks and doesn't grow, it's people aren't working as much. So the government isn't as collecting as much taxes. That expands the deficit too, because the government then has to borrow through the treasury market to further finance all the spending that the government does. And again, as we're moving through this, the thing that just blows my mind, I saw another article earlier this week that says the American people now consider our deficit number 3 on the list that they care about. That's big news, because we need to start holding these politicians accountable for all the spending that they're doing, simply because neither party, Democrat or Republican, seems to have any desire to cut spending. And if we don't start cutting spending, we're looking at a serious situation. At this time, our biggest debt, our biggest deficit every year is Social Security payments. I believe it's $907 billion a year we pay. Second, interest paid on our deficit, our debt, is $579 billion a year we're paying. That's number 2. That's only going to expand. And my biggest concern here, as we just continue to spend and spend, is that we're going to get to the point that we don't collect enough revenue in tariffs and in taxes to cover the interest on our debt. If we can't do that, we start going bankrupt. And I need to do some digging too, because I don't know how much tariffs are really going to help for paying back a deficit. Because last time Trump was in office, when he tariffed China then in turn tariffed us on our agriculture, which is one thing that we are really good at exporting. It's one thing we do export, food, because the whole world needs it. And because of their tariffs, our farmers really struggled to sell in the global economy, sell all their crops. We cannot have our farmers go out of business. So what he did with these tariffs is he used it to then subsidize the farmers, gave the money to the farmers so that they stayed in business and continued to keep their farms. So it was a wash. So I don't know how much tariffs, I'm curious to see how much tariffs really help to reduce our deficit. Taxes are really where it's at for reducing our deficit. But if we keep spending like we're doing, it's going to continue to hurt us. It's not sustainable. So let me get into this article here a little bit. Again, if you ever go to the Mises Institution, MISES, it's free. And I talk a lot about the Cantillon effect. You can also download a copy of the Cantillon effect for free from there. This is a really good source of information. They do a really good job of being unbiased. They'll have some articles that are anti-Republican. They'll have some articles that are anti-Democrat, and they have some articles that are just not political. But I think they do overall a pretty solid job of not being too political, which is why I use them, because this is how I want my channel to be. So the Big Beautiful Bill, the CBO, which is the Congressional Budget Office, and what the Congressional Budget Office is, they produce a cost estimate for legislation to try to help them set budgets. They figure that it's going to be $2.4 trillion over the course of this bill, but what it is, it's $2.4 trillion. It's important for everybody to understand this is essentially the best case scenario. The CBO analysts tend to assume that recessions are not going to exist. So not only if we have a recession is there the potential for helicopter money where the government just gives people money to spend, which is not only inflationary, but it adds to the deficit to try to stimulate the economy to get us out of that recession. is when there's a recession, people stop spending, and people are not only the economy is contracting, getting smaller. People are losing jobs, so there's a lot less tax dollars to be collected. So there again, that can expand the deficit. So, and they also take at face value a budget bill's stated multi-year plans. In practice, any budget bill beyond 2 years is essentially meaningless since it's impossible to hold a future Congress to a current budget bill. That's a problem too. You have these politicians that either get voted out or choose not to run again, and then they step into the office, into this place, and they never voted for this to begin with. So it's really, really tough to hold Congress to a budget outside of really 2 years. The most realistic outcome is the proposed cuts over 10 years in the current proposal bill will never be implemented, but the spending will increase. I've seen a lot of that too as I go back and study it too, is they'll still spend what they were supposed to spend, but the amount of cuts, that they don't do all the cuts that they're supposed to do for various often political reasons. Like we're talking about cutting Medicare right now, whether you're for that or against, that's going to have political backlash. So I'm curious to see if they actually even implement any of those cuts, or if they just want the right to spend more money, which they're going to do anyways. If you look at it from how much each taxpayer is forced to pay on these deficits, if you break it down like that, during the 2024 fiscal year, taxpayers were on the hook for $1.13 trillion in interest on the debt. That's nearly $7,400 for each of the 153 Americans who file taxes. The more the deficits and the debt increase, the more tax revenue will be funneled into paying interest on the government spending of the past. Again, this is what I said before, and they mention it here. The more our deficit grows, the more investors are going to demand a higher interest rate on our treasuries at auction, because treasuries are the way that we finance our debt. It's the way that we borrow. When you were sitting at 36 trillion, 37 trillion, wherever we're at now, I think it's 37 trillion, what happens then is they start to view the United States as a borrowing risk. When something's risky, in order for you to invest in it, you want a high return. So because of that, you can't finance it at 3.6%, which is what they estimated this originally to be at. Right now it's at 4.5% for the 10-year Treasury. It's probably going to go up. It could hit high 4s or 5s. And there again, our cost to finance our debt expands. It gets more expensive. As a percentage of total government revenue, interest payments are headed back towards the highest level they've ever been. The years when the U.S. had both high interest and large deficits was the 1980s. Thanks to rising interest rates and soaring federal deficits, interest payments as a percentage of total federal revenue skyrocketed in the wake of huge deficits of the COVID pandemic, rising from 13% in 2020 to 21% in 2024. So again, the COVID pandemic, they shut everything down. What did they do? They gave everybody free money. I got $2,800. I think my wife did too. That was a standard, I believe, for most people. That didn't come from taxes. That came from them just firing up the printing press and borrowing it, adding to the deficit, and going out and selling treasuries to investors to finance it. This is the problem with helicopter money. This is the problem with just giving people money. You just giving people money, it decentivizes some of them, not all, some of them to work. And when they don't work, they don't produce, and the economy doesn't expand. Again, that's not everybody, but that's some people. That's the argument against it. That's why you want people working. That's why you need entrepreneurship. You need businesses expanding, because it expands your tax revenue. When the economy grows, your tax revenue expands just because there's more money going through the economy. That is the best way to pay off a deficit. Ideally, you don't want to cut government spending and raise taxes. You don't want to do both. You really don't want to do either, although I'm okay with cutting government spending just because there's a lot of wasteful spending. But you don't really want to raise taxes. You want to grow. You want the economy to expand. You want to expand your tax base, meaning everybody's more prosperous. That's the best way to do it. Giving people money, encourage them to spend, but then you have inflation. And we saw that part of the COVID pandemic simply because we had cut we had severed the supply line by shutting everything down. So we were no longer manufacturing anywhere in the world. And then we gave everybody money, and they went out and they started to chase these goods and services with this free money. And as they chased it, it wasn't being replenished because it wasn't being produced. So prices started to elevate to try to find equilibrium. That's how we had, and one of the ways that we had such bad inflation. So you really want the economy to expand through jobs, through business creation, through entrepreneurship. You don't really want it through helicopter money, even though that's the easy answer. And then this article just goes on then to compare the 80s to now. You got to remember with the 80s too, we had really high inflation, and Paul Volcker, the Fed chairman, was jacking up the interest rate to try to break the back of inflation at the time. So that's why we had such a high interest rate back then. That's not okay. So it goes on to say that the economy currently, that's not as high as what the U.S. experienced during the 80s, but it's important to note that the interest was being driven in a period primarily by high interest rates, again, because we were trying to break the back of inflation, and not by deficits. We weren't anywhere near as indebted as we were now back in the 80s. The national deficit as a percentage of GDP in the mid-80s was half of what it is today. In the mid-80s, the national deficit was about double annual federal revenue. Today, it's more than 6 times annual revenue. If interest rates today were to rise to the levels that they were in the 80s, most of the federal budget would go to interest alone. Again, this is my fear. Our deficit is continuing to expand. Both parties are spending too much. Now we just bombed Iran last night, and again, I don't want to make this political, but we really cannot afford a war. So hopefully this doesn't escalate into any type of a war, because we'd have to borrow billions, if not trillions, to fund a war, any kind of war. So we don't really want that. And if interest rates expand anywhere like they did in the 80s, as they're talking now, as they say in this article, we're in serious trouble. We won't be making enough money in taxes to cover just the interest rate alone on our deficit, let alone pay the deficit down, which we desperately need to do. So then meanwhile, the United States in recent years outpaced other major economies to become the country with the largest deficit service burden. For example, when compared to Canada and major European economies, the U.S. pays by far the largest amount of interest as a percentage of revenue. The trend in the U.S. has been clearly upward since 2012, but surged well above peer countries after 2021. Part of that's because we're the reserve currency of the world, and that's Triffin's Dilemma, which I have a video on my channel. So if you like this video, you can subscribe. Triffin's Dilemma just basically says, as the reserve currency of the world, you always run deficits and trade deficits, because you need to be able to get your currency out there to the rest of the world, because it's used to settle transactions in the global economy. And the only way to do that is for the other countries to produce something and then sell to us that we buy and pay in dollars. And then they take those dollars, and they in turn, what they've done in the past is come to our auctions and buy treasuries and settle global transactions in the global economy. Now, we're seeing less of that now, partly because of the tariffs. It looks like other countries are upset with us, so they're scaling back. And other countries are starting to invest a little bit less in the United States and more abroad, looking for other areas, which even if they do it by, say, 3%, all right, say China and Japan stop investing in the United States by 3% this year. Think if that doesn't sound like a lot, 6%, think if 15 countries did that. Again, now that's the Cantillon effect, which is also on my channel. We constantly need new money coming into the system. All right, if we don't have new money coming into the system, we all fall into misery and poverty. So we need to be able to sell our treasuries to not only just to us, local investors and local businesses, but to foreigners to get that new money coming into the system. And we want foreign countries investing, buying our stocks on the stock market, and investing and opening and investing in businesses within this country, because that's new money coming into our economy that stimulates it and starts to build businesses, puts people to work, generates tax dollars. So Then it just says, most concerning is not where the United States U.S. physical situation is right now, but where it is headed. I'm very worried about where it's headed to. We keep running these deficits and keep adding to it. As the total cost of paying interest on its massive debt continues to spiral upward, there is virtually no political support at all for cutting spending or deficits from either side of the aisle. With a combination of mounting debt, rising interest rates, and endless deficits, we can expect interest payments to further swallow up federal spending. So they're basically saying what I said. As the debt expands, they're going to demand higher interest rates. I keep hammering that home because I want you to understand that. If we keep expanding and getting to 42 trillion in debt, investors are going to want to buy our 10-year treasury at 4.5% interest. They're going to want 5.5%, and we're going to get to the point where we cannot collect enough taxes to cover the interest payment alone. So we don't have to pay our whole deficit off. We don't have to get the 37 trillion paid off down to a zero balance, not at all. But we have to start bending the curve, meaning we got to start running some surpluses year after year after year, and stop expanding it and start cutting it back 37 to 35, maybe to 30 trillion. Start bending the curve and start having other countries and investors trust us better and want our treasuries more. And then that'll lower the interest rate, because that's how treasuries work. The more people bidding on it, the more expensive the bond is to buy, and the lower the interest rate is. If you don't have a lot of bidders, they have to lower the cost of the bond and raise the interest rate, which is called the yield, to try to attract more people. It's a supply and demand thing. So then this article just finishes up by saying, an alternative to this scenario is one in which the central bank intervenes to force interest rates on treasuries, thus lessening the upward swing in advance. This, however, requires the purchase of treasuries with newly created money. In this scenario, the raising interest burden is replaced with a burden of price of inflation. There is no paying solution. That's quantitative easing. Basically, the central government creates a bunch of money, enters the auctions for the treasuries, and they start buying. By the central bank buying, they start to the interest rate. Problem is that's inflationary. So this is all stuff to keep watching here. We'll see what happens in Iran. As far as fighting another war goes, if this continues, our deficit continues to expand, again, it's important to buy assets. Look into cryptocurrency, gold, silver, precious metals, the certain stocks. The stock market is a good place to go, an ETF, something like that, real estate, a chunk of money maybe just to be able to take advantage of deals when they come up. But you have to learn to invest, and investing is so much more than knowing what stock to buy or anything like that. It has to do with what's going on geopolitically and economically, and it helps to know the basic economic laws that I teach on my channel, Cantillon Effect and Triffin's Dilemma and Gresham's Law. Those economic forces and laws are in play in every economy. It doesn't matter if it's a capitalist, a socialist, or a communist. You cannot regulate them out as much as governments try. They're within the economy, and they're wreaking havoc within the United States right now. It does play a reason why we're so heavily indebted. It's not just that Democrats and Republicans don't have any desire to cut spending. It's economics too. So you want to learn that. Once you start to piece this together, it will help you make better informed investment decisions. I'm not going to actually recommend an investment to you simply because I don't know you. Everybody lives their own economy within the national and global economy, but you need to process this information, and then you and your family can make the decisions best to protect you in the future. That's what I got for you today. Working man investor, keep grinding, people.